what's all this business about goldbach levels?
In this video, I'm going to share the secret of what an order block really is. So this knowledge is from when I was working at Goldman Sachs in the City of London many years ago. Okay, so it matches very much what happened on the trading floor in practice and what you see in the charts as to how ICT trades order blocks and his order block theory. So a little bit of background first. There's different types of trading. There's prop trading, where traders are taking positions for their own book. And then there's facilitation, where a client wants to trade a certain amount, but they don't want the hassle of trying to execute that on the exchange because they may not get the price they want. There'll be slippage, the market will move. So what they do instead is they agree with someone like a broker dealer on a price of an asset for a certain time, and that's how it's traded. So typically what used to happen at Goldman is you would have a trader or a salesperson on Bloomberg chat, and they would agree with the client a certain trade. Okay, so let's say that the client wants to buy some Euro USD. Okay, that's the contract they want to exchange, that they want to enter into with Goldman Sachs. So let's say this is the client. Okay, so the client wants to buy Euro USD. Okay, and they'll give a rough price. They'll say, I want to buy it at 1.09. Okay, so let's say they want to buy it roughly at 1.09. Okay, and then there'll be some back and forth between the parameters of the trade. So if the client is wants to buy a certain quantity at 1.09, then Goldman Sachs, that's where I worked, so that's what I'll use in my example. Okay, they will be saying, okay, we will sell you EU, and they usually say at roughly 1.09, but we will give you the volume weighted average price. Okay, now that volume weighted average price could be of the day, of the 15 minutes, of the session, whatever it is. Okay, so what then happens is there's an agreement between Goldman Sachs and the client. Now Goldman is going to go off and acquire those lots. Now there's a risk between Goldman providing Euro USD to the client and the client returning the funds. Okay, that's called counterparty risk. Okay, because it may take a number of days for this trade to settle. Okay, because you have market risk where Goldman has said, look, I'm going to give it to you at 1.09. So there's market risk that Goldman has now taken on, but there's also counterparty risk because you might buy this and the client may not pay you. Okay, so what happens instead is once this trade is agreed, okay, once the trade is agreed, what Goldman says is, okay, we will settle this trade on the exchange. Here is the block number of our trade. So whatever the block number is, it could be block number, 542. Okay, let's say it's 542A, and I can't remember the block numbers because it's been too long. And then the client would have a corresponding block number. Okay, so what would happen now is Goldman would have as its counterparty the exchange. So instead of providing Euro USD to the client and the client providing the funds, the counterparty will be the exchange. Similarly, the client's counterparty will be the exchange for this contract, for this half of the contract. Okay, and they have a block number which is the reference for this particular trade. So that way, it's highly unlikely that the exchange is going to go down. Okay, so they've reduced counterparty risk. They haven't eliminated it, but they've taken it into account because now, instead of a company being the counterparty, the exchanges, and the exchange has a lot more money and a lot more backing and a lot more liquidity, so they are seen to be safer. Okay, so this is how it actually works. Okay, so Goldman goes out to the exchange, goes out to the market, accumulates what is required, and then the client has the funds ready and they pay the exchange. Okay, now there's a settlement period, okay, which occurs. And this is where all the magic comes in. Because Goldman may go to the exchange and say, look, there's my part of the trade, okay, but the client may only pay T+2, T+3. They may settle the trade a number of days later. Okay, so how do order blocks work? So this is Goldman. So what they may have done is they go to the market. Let's say this is their order block. So this is their part of the trade. This is their order block. And that order block would have a volume weighted average price. So let's say the volume weighted average price is 1.09, and I can't see that 392, something like that. Okay. A number of days later, the client will then settle the trade. Okay. And the client's trade will be the opposite. But what does the market have to do? The market has to remember where this trade is. So this is the order block from Goldman. And when it's time for the market to then cross, so what we used to say is we will cross on the exchange, right? The Goldman will cross on the exchange with the client using the block number. Okay. When it comes to crossing, the market will then remember that price, come back later, and then this is the client's part of the trade. There we go. So now the client has been able to buy at that same price. This is how order blocks work. This is exactly why you see these down closed candles, and unless the order block is mitigated, price will come back to it later. Now, why does ICT say reference 20, 40, 60 candles back? It's because you have to settle a trade within a certain amount of time. This is how order blocks work. Now, some extra information for you guys. So let me just remove all of this. As you know, I'm a big advocate of goldbach and the goldbach trading levels. So this is how goldbach works. There is the order block in the order block GB level. Okay, there's your fair value gap. In your fair value gap GB level, and there was your breaker. What did price do to facilitate the client order? Came back, mitigated this order block. This down closed candle was mitigated, and then the market was allowed to go higher. Okay, it wasn't buying or selling pressure. It was the fact that there was an open order here that needed to be crossed on the exchange within a certain amount of time. So while other orders were being crossed, okay, at some point the client would have provided their cash, okay, to the exchange. At that point, the algorithm says, okay, I need to now cross this. There's the cross. Okay, so speaking to a number of middle office and back office people, so the way it works in an investment bank is front office is sales and trading. Middle office typically check the trade to ensure the economics are correct, and they facilitate with the middle office of the counterparty to make sure that the economics of the trade are good. It then flows downstream. Settlement typically happens in the back office. So after speaking to a number of back office people, they would see our orders at Goldman come in on a certain day, and then within a certain number of days, they would see the market come back down. Now, they didn't know about ICT order blocks, but they knew that Goldman placed an order at this time, at this price, and the algorithm, they don't even refer to it as an algorithm, but the market comes back at the same level to cross the trade. Okay. If you would like to learn more about how I trade order blocks, fair value gaps, using my time and price golden bullet, then there's a link to my mentorship program below.